All right, let's go ahead and get ourselves going, and James, I'll start with you, and then I can take over and share.
Okay, so just a quick introduction to Nicole. Nicole has been in the commercial real estate space for about 25 years, owns many thousands of doors or apartment buildings or mobile home parks and a little bit of self-storage across 11 states. So she knows what she's talking about. And I actually took her class 6-7 years ago, something like that, and haven't looked back since. So she knows what she's talking about. So Nicole, it's all yours.
All right, and thank you. And I am going to, wait a minute, I'm going to come back here to this. And I share my screen. And we're going to use a couple of things. So tonight we're talking about kind of investing in tertiary markets. And I want to start out with, let me get this up so that we can see the whole slides. All right, can you see, James, can you just see the slide deck at this point, just the one slide?
Yes, looks perfect.
Okay. So the first thing I want to talk about here just briefly is why I think tertiary markets are a good thing to invest in right now. There's been, as everybody's aware, there's a lot of changes going on in the economy. The interest rates are up a lot in the real estate market. Inflation has been up, although it is starting to come down. But we still have interest rates, and the Fed just recently raised those rates again. So that has put a change on the in how many houses are on the market. So I think that has really flipped the market over to where it's starting to become a instead of a seller's market, a buyer's market. So the days on market are going up, the price of houses is coming down. So tertiary markets works, I think, for both single family and for multifamily. And we're going to talk about that a little bit more. But if you remember, even in the fall, when prices were still going up so much, that the interest rates were really low, there was some things going on that didn't make a lot of financial sense because interest rates were so low that people were having what they were trying to sell both houses and apartment buildings for was ridiculously high. And in the commercial world, in the multifamily world, that means that the capitalization rate that they were asking was low. So cap rate, just to remind us, is how much you would make on your money if you bought something for cash. So if you're buying something at a cap rate of 5 or 6%, that means that if you bought something for cash, you're going to make 5 to 6% on your money. Well, right now, the cost of the interest rates are above 6%. So your cost of money is actually significantly higher, or not significantly higher, but it's higher than than what people are trying to sell for, which means that it doesn't make a lot of sense. I like to see at least a 1.5 to 2 point spread where my cost of money is lower by 1 to 2% lower than than what I'm buying, the cap rate I'm buying it at. So I have a little built-in stuff there. Okay. So what's happening now, though, is that it has always been in small markets. So tertiary markets are typically 50,000, 100,000, 50,000 and less. So they're the small markets. Prices didn't go up there as much as they did in some of the primary and secondary markets where housing prices got way high. So the other thing is that in those primary and secondary markets, you had these big hedge funds and other things coming in and buying both multifamily and bunches of houses at a time for cash. And they didn't really need to make much money. If they could buy something at a 4 or 5% cap rate, and then because they were paying cash, and they made 4 to 5% on their money, and they were okay with that. So what that means is that the prices in secondary and primary markets were higher. What we need as investors, if you are using some other people's money, if you are trying to find investors, or you are just trying to buy yourself, is you need enough of a spread that you can pay investors something on their money and you still make money. So tertiary markets the prices aren't as high. There tends to be, there don't tend to be as many big multifamily properties for sale, but it is fairly easy to find 5-10 unit properties. And the truth is, when you're getting started, there's a lot of reasons to think about starting in a smaller, with the smaller units. They're a little bit easier to manage. You may not need a sponsor. They are, I think a lot of people are concerned, shall we say, about tertiary markets because everybody says, well, they're so small. Well, they are small, and that's part of the point. And part of what I'm going to show you after we go through this slide is a way to try and convince you why tertiary markets aren't a bad deal. But one of the things, as we kind of look through the census information, which is where we're going in a minute, is that there are a significant lack of rental units a lot of times in these smaller markets. Not everybody owns their own home. And so one of the things we go looking for in some of these smaller markets is markets that have reasonable employment, that aren't losing population, and where there is a fairly good number of people, of households that don't own. And we're looking at households, not individuals, because it's in a household that people tend to move. And so if you have I'm making this up, a city that has 50,000 people in it, let's just say, and 45% of those households own their own home, then that means 55% don't. And there is room to buy small multifamilies, to buy rentals, and have a good return. There is a lack of affordable housing around the country, and that is also true in smaller markets. A lot of investors don't go to those small markets. I've never been quite sure why, other than I think there's a lot of people that teach that you want to be in big markets because that's what they've heard. Now, the majority of my properties are in secondary and tertiary markets. And part of the reason is easier to find deals a lot of times. They are more reasonably priced. It's somewhat easier to get the information you need. And while this may be I don't say an exaggeration because I don't really have any data to back it up, but I get the sense that there crime isn't as high a lot of times in smaller towns and cities as it is in some of the bigger cities for a number of reasons. Another reason why I like tertiary markets is it just isn't a lot of competition, and that's basically what I just said. So what we really want to look for when we're trying to buy single family rentals or apartment buildings, mobile home parks, to me, what I'm looking for is something that I can buy at a reasonable price, that they're not asking a 5 or 6 cap rate, that what you can buy them for, and therefore what the mortgage is going to be isn't as high as what you can rent them for. So to be able to make money in this, you have to have rents higher than mortgage payments, right? And so a lot of times you need to find places where the rental costs are reasonably priced, but the purchase price isn't so high. So you need that spread. We would want to have places where we don't have a lot of competition, certainly not the competition from the big boys who are coming in and buying cash. And I don't know of many of the big boys who are actually renting or buying in tertiary markets. And we want something where there isn't enough rental housing. So that's some of the reasons I am pushing that tertiary markets are a good place to be. So the next 2 slides, I am going to let you take a quick look at this, and then we're going to switch this up. And we're actually going to go to the census.gov, and we're going to look at some of this information so you can see what I'm talking about here and how you can do some of your market analysis to find some of these places that might be good places for you to start looking. And so this slide and this slide, now you're going to get the slides. James is going to be posting this up on, is it YouTube, James? When you edit these, do you put these up on YouTube?
I'm sorry, I was on mute. Yes, it usually goes out within a couple of days.
Okay.
And I'll put the YouTube channel in the chat towards the end. And you're at about 8:20 right now.
Oh, okay. So let me just, whoops. Let me stop.
6:45.
I need to stop share. And I'm going to share something different here. Where is there we go. All right. All right, now I'm going to go back for a minute. So if you look at this, I'm going to go back this is the census.gov. And so this is the census information. And we're going to put in here, I'm going to try, and so I've set up Winchester, Virginia, and we're going to search on it. So when you do the search, you can put in a city there, and we're going to search, right? What you see here are some general, what we start looking for to begin with is that we want to see what the total population is. And you can see there, we're about 28,000. So that's less than 50,000. The median income, I'm interested in that because people need to be able to afford to rent what I am selling. So there is a relationship between the household income and the average rents in the area. And you're going to see, you'll see here in a couple minutes what the average rents are. The other thing I want you to look at is the employment rate and the total household units. This one is important. When we go to the next slide, you may not see this. So you may want to notice that there's a total here of 12,372 housing units, right? Whereas the number of total households is 11,000. So according to this, you have some extra housing units compared to the number of households. Now, there's always some error in these datas, but what we don't want is something where there is a huge, where it looks like it's been way overbuilt. So the next thing we're going to do is go and we're going to look at quick facts here. Whoops. And I want you to look, I'm going to just hit the highlights here because we're going to come back and let people kind of ask questions as they want. So one of the things we're trying to figure out is this a stable market? So for tertiary markets, I don't necessarily care if they're stable, if they're not growing a lot, as long as you don't have markets that are losing population. And so if you look at these two, the population in 2020 was 22,970. And in 10, it was 21,374. So there is some growth, right? So that's a positive. So that one meets my criteria. It's not losing population. It's gaining a little bit. So over 10 years, it gained about 1,500 people, which at 21,000, it's about 7%, something like that. So it's actually a growing area. Let's go down and look at housing now. That's the next big area. So remember how I said the housing units, remember we have about 12,000 because a lot of times in this data, for whatever reason, this doesn't come through. Okay. So here, if you look at this, owner occupied. So there's 82% of those 12,000 plus units that we got from the other one are houses that are owned. But that means we have about 18%, or somewhere around, 2,000, something like that, that don't own their own homes. So there is some room. We have, somewhere around 20% of people who don't own their own homes. So there is a need for rental housing or for other housing. Here is the mean value of owner occupied houses, right? The median value. Okay, so this is inaccurate. So this is, it says the median, I know the median value is not $1 million, which is what that says there.
Right.
So I don't know, we'd have to do a little bit of looking to figure out what this is. I just want to make sure I'm still in Winchester, Virginia. Yep. Oh,
no, you're
you know what?
Massachusetts.
I'm in Winchester, Massachusetts. All right, well, let's just look at Winchester, Massachusetts. We don't have a lot of time. So it may be $1 million, which means that it's probably not very affordable. Let me change my mind, and I am going to go back here, and I am going to change this to Winchester, Virginia. Winchester, Virginia. Okay, so let's look at this again. Sorry, you guys. So population 28,000, 26,010. We're going down to housing. So if we kind of go back over here to quick facts. Total housing units is still about 12,300. All right. So now if we're looking here, only 45% own their own houses. So big rental market, the average housing costs 270,000. And that's about right. I think that's probably about where things are. It says the median monthly cost, we're not really going to pay things this. Let's look at the rent here for a minute. The median gross rent is about $1,100. Now this is, understand, this is coming from the 2020 census. We're in early 23, and what's happened over the last 2 years, there's been an incredibly uptick in what houses sell for and what rents, things are renting for. So we can't pay, we can look at this for a first screen, but what we also want to do then is go to rentometer.com and look at or do a Google search on what the average rents are in Winchester, Virginia, to see how much this has changed, and it will have changed. All right. So about 14% of people moved over in between 19 and 20. And so I just want you to sort of take a look. This gives you some ideas about what the economy is, right? How many people are 16 years, total percent of the population age 16 years? So this tells you something about total retail sales, healthcare costs. So those are some of the things we are really looking at. We want to see kind of the employment rates, things like that. The other thing we can do, if you start, I'm not going to kind of go through this now, but if you look here, there's a map. You can click on the map. And you can see Winchester and where it is. Now, I use this because sometimes I will find a secondary market, and I will look to see what are some of the towns around it that I can also look at as potential places to see if I might want to buy some of things there, and I can go back and look. So one of the things, if you kind of figure out an area, you can see other towns around it. So if you're looking out from, say, if you take Baltimore, Baltimore is a primary market, but if you move out from Baltimore up towards York or out towards the Eastern Shore, what you begin to see is that those are tertiary markets, and people commute in. So one of the things we can find when we're trying to find tertiary markets is if you live in a city, then what I would do is I would go out towards the outer commute areas from that city and see if you can find tertiary markets that you like there. All right, I have talked a fair amount. I'm going to stop sharing this, and I'm going to go back to the slides for a minute. There we go. All right, so I'm going to open it up for questions right now. And we'll kind of we'll take one property or one city. We'll let somebody pick a city, and we'll see what we can find from that. Before we do that, go back and practice and take questions. I just want to put this up, that if you want to know more information, kind of just more general information, we've done a webinar that's free. It's a multifamily webinar, and if you go to that, you can, to that address, you can get access to it. And there's our YouTube channel where you can go and where this will be posted. So I'm going to, at this point, I'm going to open it up to questions. And if you want us to go back and find another city to work through, another town to work through, we can do that. So I'm going to leave my slides up here for a minute, or I'm going to go back and get up the census.gov information. I hope. There we go. And we'll turn it over for questions.
And you guys can just unmute. I think that's probably easier.
Hey, Nicole, I had a question.
Sure, Darren.
Hey, I'm going to Ohio this weekend to actually look at apartment unit complex. And I was wondering, how do I go about getting funding for that? I ran the numbers on it. It's a 14 unit. It's hold on, I got the numbers right here. Yeah, it's a 14 unit. It's got a 13.43 cap rate. It's bringing in $95,000 cash flow yearly, and it's a 29% cash on cash return.
Okay.
And it's fully occupied.
So the first thing I would say is this in a is that there's a, whenever I see a cap rate like that in this market, the thing that comes to my mind is, what's the problem with it?
Okay.
So some of the things you can quickly scan for are crime.
Okay.
The other question I would be asking is if these are actual numbers or if these are pro forma numbers coming from the broker.
Oh, I ran numbers myself, and they also had sent me the rent rolls, the taxes, and pretty much everything. They emailed me everything, and I ran the numbers with what they had.
Wow, that's great. If you can find those units, that may be a good one. For finding money, you need to start having meetings with people. You need to find potential investors from the get-go, from the time you want to start finding these properties, because you have to build relationships with them. You cannot share those numbers that you just shared with me with the cash on cash return or the what you expect it to make.
Yes.
You can share what the income was, what the expenses were, what the cash flow was. You can share other basic information, but you can't put anything out there that would make people think that you are guaranteeing or promising them a return. If that's a great deal, if when you start doing the due diligence, things pan out. Like I said, if I saw cap rates like that in this day and age, I would be sort of saying, okay, what are they not telling me? Because if you remember, in residential real estate, there's a lot of consumer protections where people have to disclose. In commercial real estate, they don't have to disclose.
Okay.
And so it's a case of buyer beware. Now, they can't lie to you, but they also don't have to disclose. It's a case of things that you have to go find out.
Gotcha.
So that would be great. Is it in a smaller town where that?
Yes, it is in.
Don't tell me, because I don't want somebody coming after your deal.
Okay. All right, but yeah, I will say it's in Ohio. It's not in Cincinnati or nothing like that, but it's in Ohio.
Okay. So the other thing that sometimes happens if it's in a smaller town, what you're going to see is that residential realtors will put something up. And so it's not actually being offered by a commercial broker, a commercial realtor. So, and those tend to be, that's another reason I kind of like smaller markets, is because you don't always have the big commercial guys who really know how to value properties and stuff. And so residential realtors use different criteria and different ways of looking at what they can sell a property for. So those are some things to look at. All right, so it's
Okay,
7:03.
I'm sorry, I don't want to hold another too much of your time. I just had one more that I had to send an offer in on tomorrow. I wanted to know, what did you think about this one, real quick?
I can't
Oh, okay.
give you a what I would do is, if the numbers pencil out,
Yeah.
I would offer something 10 or 15% below what they're asking.
Okay.
Or you can offer, the other thing you can do is you can offer the close to what they're asking, but put something in it that says, I'm willing, this is what, if all information in due diligence checks out as reported, then this is where I might be. But you don't sign anything at this point. So it's a non-binding offer.
Okay.
That is kind of like an intent, a letter of intent, if you can come to agreement and if the due diligence period proves that the property is as they report it to be, or you don't find anything that would make you walk away from it.
All right.
All right.
Okay, thank you.
Yep. Now, I don't have any problem staying on if other people have questions, but I don't also want to be respectful of people's time.
I got one question.
Sure.
Yeah, it's Michael. The number with regards to the owner occupied numbers with the census, what's your top number that you don't want to go over with regards to the owner occupied percentage?
Once you start getting above 80-85%,
okay,
there isn't much of a rental market compared.
Okay. All right. So
unless it's a fairly good sized. So, but anything below that, there's a need for rental housing. It's surprising to me all the time how much in the smaller towns they'll tell you we just don't have enough rental housing, so they stay rented pretty consistently.
okay, and then when you're looking at that gross rent number, if you're evaluating properties in, let's say for this instance, Winchester, you would like to see, of course, rents that would be lower. I mean, lower than that median gross rent. I mean, how much weight do you give to that gross rent that's here on the census?
Okay, so what I would say right now is that the gross rent in the census.gov shouldn't really be trusted other than an initial screening.
Okay.
That's why we use things like Rent-O-Meter. You can put in a specific address.
Yep.
Or a certain area, or you can go to some of the realtor in the area and ask them what things rent for in and around that area, to find out what's actually happening on the ground. But things have changed a lot in the last 2 years in terms of prices going up and rents going up. And so I already know that what's here in those areas is probably not as accurate as you want it to be.
Okay.
But it's still a good screening, right? If this had the average rents were, I'm making this up, $700 a month, right?
Yeah.
But the average cost of a house is $270,000. That just doesn't pencil out in anybody's. It doesn't meet a regular sniff test, right?
Right.
And a house at $270,000 is going to have a mortgage payment of what, somewhere around $1,800, $2,000.
Yeah. Yes.
And if rents are not, now it may be less than that, but if rents are $700, there's just no way you can make that.
Right.
In commercial real estate, you want to kind of get a sense of what the per door cost is. So if you're buying a 10 unit and they're asking $2 million, right? then what is then the average cost per door that they're asking is 200,000, and that's a little crazy.
Right. I mean, I need to be 2,000 a month at least, or one.
Yeah. So, or more, because you're still going to have expenses. You're going to have taxes, you're going to have insurance, you're going to have
Right.
repairs, you're going to management. So, yeah.
Yeah.
All
Okay.
right. So I'm happy to stay here and answer questions other people may have. If you want to look at one of a city in your area, we can do that quickly and we can walk through it. So I can stay here till 7:30 and then I have a hard stop. But I want to be respectful of time. So if people want to drop off, I appreciate very much you coming. And we'll see you next Tuesday. Next Tuesday, what we're going to talk about is I'm going to talk about some of the smaller, lesser known cities or areas that I think might be, now they're not tertiary areas, but other areas where I think that they're under-recognized as having, as being potentially good places to invest. And I can tell you more about that next week. And so open for more questions, or we can, if we no questions, we'll say goodbye. So I'm at your disposal here for the next 20 minutes.
There's actually one in the chat. So someone's asking.
What is in the chat?
I'm finding that Baltimore brokers are listing properties at 4 to 6 caps right now, often in properties that need a lot of order to bring in market rents. Are there simply lots of investors out there that don't care and will pay these prices, or what do you think is happening here?
I guess what I would say is that if you're talking about Baltimore City, there are certain areas where they're good areas, and there are certain areas that aren't. And those of you who live in Baltimore or around, invest there, know better than I. I think any place with asking at a 4 or 6 cap rate now, given the interest rates, has been smoking something. So you're already starting to see the cap rates come up some. So at this point, I would not, frankly, be buying something where I couldn't buy at an 8 cap or get to an 8 cap by the end of year 1. And so if somebody's asking a 4 to 6 cap, they obviously haven't really looked at a lot of, I want to sort of give brokers a break here, because a lot of people who put their properties up for sale are not quite clear maybe that the market has changed, and have seen what other things have sold, and they think that's what their property should sell for. And some brokers will take those listings and list it where their seller wants it, and then when it doesn't sell, they'll try and convince them to raise the cap rate or lower the purchase price. But something that's at a 4 to 6 cap rate, in my estimation, just isn't doable, given the current economic situations. And I wouldn't be looking too much at those properties. I really 7.5 and 8 cap. Right now, the cost of a multifamily mortgage, if you have good credit, is 6.5, 6 to 6.5. And if you want at least a 1 to 2% kind of improvement, so you want a spread of at least that, then that means 7.5 or an 8 cap. If somebody's asking a 6.5 cap, a 6 cap, I want something at a 7.5 to an 8 cap to buy it, or an easy way to get there within a year. Did that answer that question? Who asked that question?
Okay, Rob says yes.
Okay.
I think he's the one that the microphone doesn't work.
Okay. All right, so is this Aaron that wants another example? Was that you, Aaron? I see your picture there. Have I got your name wrong?
Nope, you got me right. Sorry, I was on mute.
All
Waiting
right,
to get
you
off
give
mute.
me a city here and
Okay,
let me kind of go back.
let's do York, Pennsylvania.
Okay, now I was looking at that. Let's and it doesn't have, so York County, Pennsylvania, and then we'll see if we can find just York, okay?
Okay.
But the
And York,
county's big.
Yeah,
It
it is pretty
doesn't
big.
have the city itself. So let's kind of look down here. So if you look here, can you see this? Where there
Yep.
is, this is York County, but this is York Township, right? Can you see where I'm pointing? The first one here?
Yep, I can see.
Okay. So if you're looking at just York County, this has got a big population, right?
Yeah.
450. So let's just see what York Township looks like. Now, what you're not going to get is you are not going to get the overall. So here's the population estimate in 2021. So you tell me what you see here. Here is the population of York. Does that meet our criteria, Aaron?
I
Under
can't remember.
50,000.
Yeah, that's a no then.
Okay. Look
Or-
at six things we're going to look at. Go ahead.
Yeah, so there's been growth there, which is a good thing that we want to see.
Yep,
Is
there
it-
sure
is it-
has.
Is that significant enough growth to you
Well,
think to be viable?
So you've got about 2,000 growth, right?
So it'd be about
2,000
10-ish
people.
percent.
And you're at 27, you're about 27 to 30,000. So 2,000 divided by 29,000 is what, about 8%,
Yes.
something like that?
Mm-hmm.
Is that reasonable?
I would think so. Yeah.
I would think so too.
Yep.
Okay, so what are we looking at next?
We are looking at the housing stats.
Okay. So what we don't get here is the number of housing units, right? Because that's something that's generally over in another, over in the overall facts. And all we had there was for the county.
Right.
So we may need to kind of do a little bit extra there, but this is just a screening tool, right? So how many is owner occupied?
67% or 60,
What does that mean?
almost 68%.
How many people, what percent are renting?
So we have 32% that are renting then.
About 32% that are renting. Is that good?
That's good.
Okay. What is the median value of a house?
205,000 almost.
Yeah. So what a mortgage payment for that is going to be, PITI is going to be probably somewhere around 1,500. And I don't know what it is with the new interest rate. So you're going to kind of have to look at that.
Right.
So what's the median rent 2 years ago?
1150.
Yep.
So that checks as well.
Yep. So you have to have, though, we're going to go back and we're going to check this, how much this has gone up, right?
Yeah.
But so what I'm probably looking for here, because the median is the middle number. And I am too close with rents. The rents and the mortgage are too close to the same. So I'm probably going to be looking for houses that are in a first-time home buyer kind of range, where I can get for 150 and less, because I need that mortgage PITI down around 1,100, something like that,
Okay.
Or less. so that I can make a little bit of extra money there. So if I was looking at a multifamily, I would want units per unit cost to be under 45, 50,000 to be able to rent them and have that pencil out.
Okay.
All right.
Yep. That makes
Nicole,
sense.
Yes.
Nicole, this is Michael. Can you just go? I need a little help understanding that because I was tracking, but then talking about the mortgage PITI. When you said, hey, you want to get the mortgage lower or the overall home ownership amount lower, and the way my mind is working is if I'm focusing on that, then I would be potentially losing renters if they could afford to buy. So maybe I just misunderstood what you were saying there.
Okay. I probably wasn't very clear. So what I'm saying is if you look at what the average house, now understand median house means, it takes into account the high end and the low end. It's the middle number.
Right.
But on average, the mortgage, just the mortgage payment on a $200,000 house is going to be around $1,500, right?
Yeah. Yes.
Okay. But what is my average rent?
$11.59.
So I'm going to be running cash flow negative if I'm buying at the median.
Oh, okay. If you're okay, now I understand. If you're buying at the median, so you got to get your buy per unit price down. All right.
You do, and you have to. And if you're in the single family market, you need to be
absolutely.
You need to be buying houses below the median, because what I need is a spread. So I can put some money in my pocket and I can pay the bills, right?
Yeah, no, I clearly understood. I just,
okay.
Yeah.
All right.
All
so
right.
actually here are a number of households. There's 11,000 households and there's 2.5 people per household, right? And so that kind of, that means that there's approximately 5,000 people that are not in households, or that, well, never mind. That's something we don't need to go over right now. So did that get Erin, coming back to you, did that get that for you?
Yes, it did. Thank you.
All right. So
great.
Let's do a map just real quick. So there's York. Do you see other places around there that may also be good for looking?
Yeah, I think a lot of them are actually, because York itself is a little, I think there's even more opportunity around it, especially more to the south of York County.
Yeah, because a lot of people from York commute down to Baltimore, right?
Correct. Like Shrewsbury Township, Springfield, Hopewell, that whole that corridor right there would actually be pretty good to check out as well.
Right. Does everybody kind of see what we're talking about here now, about how you can use some of this census data?
Yes.
To find potential areas, potential tertiary markets that might offer some opportunity. And one of the things I really want you to take away from this is the number of households, or the percent that do not live in owner-occupied housing. That's going to tell you a lot of where there's some opportunity. All right. Any other questions?
Is there a certain number or guideline you recommend around that? Like how what that difference should be?
Okay. Can you re-ask that question? And
Like
is your name pronounced Omer or Omer?
Omer, yeah. Yeah,
Okay.
Omer, that's right.
Okay.
The number of and just send, there should be. I know you mentioned earlier you shouldn't have a scenario where they're overbuilt or you have too many houses. That's not a good scenario. But I guess I'm trying to look at what's considered a high or a low in terms of where there's good opportunity to invest versus maybe you should pass on.
So if I was to come down here, let me see if I can answer this. There are, let's see now, where did I find number of households?
I think it was further up.
Yeah, it probably was.
There you go.
Yeah, Nicole, I think he said it should be greater than 85%,
Yeah,
right?
it's if it's over 80 to 85%, I probably wouldn't. I was just trying to, so 67.8% of the population live in their own housing, right? Owner occupied housing. But that means we have 32% that don't. So if I have my total households, that's what I was looking for. So there's 11,942. So basically 12,000 households, right?
Yeah.
So how many households then, if you're looking about 32% of those 11,000 people don't live in their own homes?
Yeah, 32% of 11,900 do not have homes, correct?
Do
About
not live
3,800
do
people.
not live in an
Or
owner
do not live.
occupied house.
So okay, I got it now. So it's kind of 85% is kind of what we're looking at. If it's 85 or above, may not be a
No,
great opportunity.
85 or above, you don't want. You want something
Right.
under it, really under 80%.
Yep. Okay.
And Nicole,
Because
what would be the bottom of that? So like if it was an overbuilt area and there was a very high level of non-owner owned households, what would be the low number there that you would the other end
I
of
don't
that?
know if I would have a lowest low number. What I would be worried about, what the other thing I start looking when the numbers start dropping down, is do I have an area that is really overbuilt? And so I have, let's say I have 20,000 units or 20,000, but only 9,000 are occupied. Then it is really overbuilt.
Right. Okay.
So that means that, there's just, there's too many housing units, frankly. Does that make sense?
Yeah, that makes sense. You just really have to look at all the numbers and just kind of see how it checks out.
But remember, this is a screening tool. So what we're using this for is to identify a few areas that now I can say, this is someplace I want to go look. And so now I'm going to go look in all sorts of places, and you send letters. I'm going to look through brokers. I'm going to look through realtors. I'm going to do, drive for dollars. I'm going to do all sorts of things to try and find things that I may want to buy. Remember, I'm also going to, before I decide this is an area I want to look at more, I'm going to look at what the current rents are in those areas.
And did I hear correctly, population-wise, did you say less than 50,000?
I did. So tertiary markets are smaller. So there's a lot of tertiary markets that have 75 or 100,000 people in them. But but for ease, we're really looking at smaller areas. And I'm also looking at places that are on the outskirts of the big cities, that are on the outer areas of where people commute in. right? Because even though they may have lesser populations, they have all of those jobs kind of rolling inside into the area where they're commuting in, that that makes it a little more desirable, maybe.
Got
A
it.
lot
Thank
of
you.
these small areas that are on the outskirts of, like, Baltimore or Washington or Chicago or Tampa or wherever, have seen people moving. So one of the things that happened with COVID is that people started, some of them started moving out and away because they didn't want to be in such populated areas. So there's been a lot of movement of people in the last couple of years too. That's why this is just a screening.
When you
All
say
right, we've
outside
got
of a
one
major
more minute,
metropolis,
and then I gotta go.
outside, like, would you say like an hour outside of a major city, or like something that's commuting distance? Like how
Yeah,
far out?
I would sort of say that, so in an example, in Baltimore, people commute in from York, and that's more than an hour.
Okay.
So it is in big cities, it's more, you're looking at commute time as opposed to miles. Whereas if you're out in Wyoming, in Sheridan, it doesn't really matter because it's so unpopulated, and it is miles rather than time. So in a lot of the cities, an hour isn't going to get you very far, unfortunately, during high commute times.
Yeah.
Okay.
Thank you.
All right, everybody. I'll see you next week, I hope. And thank you very, very much for joining us. I appreciate it.
Thank you, Nicole.
Thanks, everybody. Take
Thank
care.
you.
Bye.
Bye-bye.